Hey everyone, Carnival Cruise Line reported fiscal 2023 second quarter earnings results. So in this video, I'm going to update you on its latest financial results. I'm also going to update my recommendation on Carnival stock. Coming into these earnings results, I had the stock rated as a hold/buy. I'm going to update that recommendation in this video. You're not going to want to miss that. So let's get right into it. Revenue more than doubled for Carnival to 4.9 billion. That was up from 2.4 billion in the same quarter last year. Remember, the cruise lines were absolutely devastated because of the pandemic. They were the ones that were forced to shut down for the longest time as a result of the outbreak. So now they are the last to recover, and boy, they are recovering strongly, more than doubling revenue year over year, and that momentum continues. Its loss per share on the bottom line improved to 32 cents, up from $1.61 last year. The company saw continued acceleration of demand with total bookings in the quarter reaching an all-time high for future sailing. So demand is higher than ever before. That's despite the fact that Carnival Cruise Line has raised ticket prices. Prices on board are higher. People are spending more money once they're on the ships, and occupancy levels are rising. So nearly everything going in the right direction for Carnival Cruise Lines right now. Cash flow from operations improved to 1.14 billion. That was up from just 4 million in the same quarter last year. Now, this is what I've been saying for Carnival for several quarters now. When demand does recover, the company needs to use this cash to pay down this debt that they accumulated during the pandemic, and that's what they've done. They opportunistically paid down over $1 billion in debt coming due in 2023 and 2024. In total, the company paid down 1.8 billion in debt principal in the quarter. Now, typically, companies have a balance of debt and equity financing that aims to optimize or find the lowest weighted average cost of capital. Now, I'm not going to get too wonky into why that's the case and the technical why the weighted average cost of capital is the way it is and all of those details. But what I will tell you is that Carnival's balance sheet in terms of debt and equity is not where it wants to be. It's where it needs to be because of the way the pandemic hurt its business. It was in desperation mode. It needed to borrow money to survive and sell shares to survive. It was just in survival mode for nearly the bulk of the pandemic phase, the lockdown orders when the business was forced to shut down. So its balance sheet is all discombobulated now. Therein, in my opinion, lies a huge opportunity now. Because it has so much debt, its earnings are not where it would be typically with this kind of revenue. With this kind of revenue, typically Carnival's earnings would have been much higher. But because it's got so much debt, because its interest rates on those debt financings are so high, that interest expense is a huge burden. So over the next several quarters, if demand continues the way it's been going, which there is no reason to believe it won't because there's still a lot of room to recover in terms of travel spending from consumers, the company can use that cash to pay down the debt, which will decrease the interest expense, which will increase earnings per share just by reducing that interest expense, which is really, really high, right? If you're in desperation mode and you go to the bank to borrow money, the bank's going to charge you an arm and a leg on that interest rate. So that is what's plaguing Carnival. But right now, the fact that its business is booming and revenue is soaring, it can opportunistically pay down that debt, which is going to lift the earnings per share over the next 6 to 18 quarters. It's got a huge opportunity here to pay down that debt and increase earnings per share. And in fact, the management is forecasting good times to continue for the rest of the year. It raised the midpoint of its adjusted EBITDA target by 175 million up to 4.15 billion for the year. I wouldn't be surprised after the next quarter if it doesn't increase its yearly update again. That's how strong travel demand has been ever since economies started reopening in earnest with momentum early last year. So to update my recommendation on Carnival stock, I am upgrading this stock from a hold slash buy, from the borderline of a hold and a buy, up to a comfortable buy. Investors can comfortably buy Carnival stock right now because it's got a lot of leverage improvement in store for it over the next few quarters as it uses this cash to pay down debt. All right, but that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.